Well, hi everybody. Ted Greene, Spartan Investment Group. It's a Thursday on the 8th of June, and I'm joined with Alex Peters, who is the Chief Investment Officer at Hohheimer Wealth Management. We're really glad you're here, Alex, and really looking forward to learning from you and poking around in all the dark corners of Wall Street. So we're glad you're here. So this is a little bit about Alex by way of his title as Chief Investment Officer. The firm has, my recollection is 1.3 or 1.4 billion under management, and they focus heavily on the alternative space. And so this is going to be a fun half hour, 45 minutes to just poke around a little bit. I just want to remind both friends of Spartan and investors who may be new to Spartan. Spartan has been in business for 10 years. We control about $620 million of self-storage assets. Most of that is Class B, Class A, some Class C. That's the sandbox that we play in. And so if you're an investor looking for seemingly durable assets that pay consistent cash flow, or as part of our growth fund, new construction, ground up self-storage assets, we would enjoy connecting with you. We're also next week launching our DST fund, which can receive a 1031 exchange asset. So if you're a single family homeowner, multifamily, a variety of assets can complete a 1031 exchange. So please do think of us if you have assets that you're looking to 1031 exchange over the years. Some of you have seen this tool that we built. It's an Excel file that helps investors track a portfolio of private investments. We built this as just a free service that you can use on your PC to track a variety of multifamily, industrial, retail, self-storage assets. So if you're a collector of private investments, feel free to reach out to us. My contact information is there on the screen, and I did a post in May on my LinkedIn where there's a link so you can download that tool and then just email me for the instruction manual. We're happy to see you use it and be successful in using it. So Alex, turning to you, the pro, before we dig in on the investment side of things, tell us just a little bit about your background. What were the stair steps in your career getting you to where you are?
Sure. Well, first of all, thanks for having me, Ted. And I attended University of Washington.
Okay, you're off to a good start.
I'm a local guy. Grew up in Seattle, and I spent the bulk of my career in institutional management, working for Franklin Templeton, and I was an analyst. Managed several funds as a portfolio manager. Received my MBA while I was working from University of San Francisco, and got my chartered financial analyst designation as well. And so all in all, I've been managing money now for about 30 years. There are a lot of lessons learned along the way. Seen a lot of things go well and go poorly throughout all of the sectors. And I think specifically to your interest and why we're here tonight, I've been a real estate analyst for many years and have kind of seen that industry evolve. Both the public side, which has grown to be very successful, the REIT industry, but also area you're in, the private real estate markets, which have grown tremendously too over that period. So and then I just try to bring all of that experience to bear for our clients at Hohheimer, and it's a fun place to be.
So Franklin Templeton is a name that carries the swag of a Vanguard or a Merrill, world-class firms. If you were to compare and contrast Hohheimer to where you've come from, I would imagine you're maybe more nimble, or what's the...
Absolutely. I would say, I loved my time at Franklin Templeton, and that's where I learned so much. And I would say the biggest difference is we have a lot more flexibility. We're smaller, as you said. We're we're a little north of $1 billion. That means we can look at just about any investment opportunity, and it's not too small to really move the needle from us on a performance basis. So I would say that's the biggest difference between a real large firm like some of the ones you mentioned and a smaller firm like ours.
Yeah. So while we're on the topic, what is for Hohheimer Wealth Management, which you're an RIA,
yes,
registered investment advisor, which there's a couple of distinctions there, and tell me if I get this right. You don't take commissions, you charge a fee.
Correct.
You're required to do what's in the best interest of the investor and maintain a compliance file of sorts that is evidentiary that these are the investments you considered. This is the one that's the best because a variety of factors. So in other words, you really have to put some elbow grease into making a decision to place investor capital.
Absolutely. No, you're right. Everything you said is correct. And yeah, we're held to the fiduciary standard, not the suitability standard, right? Of, it's got yield, so we bought it. It's good. Well, is the investment with yield that was the best alternative for your client? And you need to be able to back that up and substantiate that.
Yeah.
And we are regulated by the SEC.
Okay. Yeah. So just briefly, I'm guessing you have certified financial planners on staff, and just maybe describe what does your typical investor client look like?
Absolutely. Yeah. We provide what we call comprehensive wealth management. And that includes not only the investment management, which I oversee, but also financial planning, estate planning. We have a philanthropy offering for folks that are interested in getting involved in that. So we really want to, and most of our clients are individuals. They'd be, typically considered high net worth individuals, and those are the type of clients that are usually looking for the services we provide, that holistic offering of all of those services.
So if mom and dad are interested in transitioning wealth to adult children, your team is capable of handling the conversations around the family limited partnership or the charitable remainder trust that feeds the family foundation and fulfills the wish and desire of the matriarch and the patriarch as far as distributing the assets, but also caring for the assets.
Absolutely.
So it's that comprehensive approach that you're.
Absolutely, yeah. That's the way our firm is designed, so that we're able to offer, all of the financial needs somebody has. We're able to offer something to them in all the financial aspects of their life.
Great. Okay. All right. Well, let's have some fun. I've been looking forward to this for a couple of months since David said that he would loan you to us for an hour. So we're glad you're here. So our first question tonight is, how do institutional investors evaluate real estate investments? And so let's start there.
Certainly. I think one of the biggest differences is how the institutional investor looks at it versus the individual. An institution's really going to look at it from a more of a portfolio basis. They're going to be starting with, what are the various sectors of real estate? What do I want my allocation of these various sectors to be? And then within that, which specific investments do I want to make? And that's true whether it's a public REIT or it's a private investment on real estate. And I think that's a little bit, I know that's different than an individual. An individual is typically going to be buying 1 or 2 or 3 private investments, and they're not going to be looking at it that way. They're not going to say, well, I'm making, many different investments. They're going to say, I'm making 1, 2, or 3 of them, and what's my return profile look like? Now they'll also consider, what sector is it, the hotel sector or the storage sector or office sector? They're going to consider that. But I think they look more at the unique project, if it's a single asset, or the unique, set of assets they're going to be investing in. And I think an institution comes at it from a much wider lens, if you will.
So, as part of the investor relations team, and as part of Spartan, just simply not licensed to provide tax, legal, or investment advice. When investors that I'm talking to start telling me what they're doing, I love it when they say things like, I'm aware of my maturities and I'm trying to build the equivalent of a bond ladder, you know, and to a CFA, and I want to come back to the CFA topic in a minute, but the sequential maturity schedule of, you know, having a hotel asset mature in 2026, having an industrial asset mature in 27, having your self-storage come up in 28, that seems to me to be low-hanging fruit and common knowledge that retail investors could employ. Do you do anything like that?
Absolutely. We're always, well, one of the things we're very tax aware for our clients. And as you know, for individuals, something less true on the institutional side of the business. You're often not thinking about that because a lot of institutions may not have to pay taxes, right? They might be an endowment or some institution that isn't subject to tax, but individuals are. So we're absolutely always thinking about that, and what you're talking about, almost like we would do with the bond ladder, doing it for real estate, which could make a tremendous amount of sense. Also, as you know, one advantage of private real estate is that you can 1031 things, and that's another powerful tax tool to defer your taxes over time. So yes, we absolutely consider those strategies when putting our clients' money to work.
So by way of the evaluation, as you look at the market today, is there anything you're maybe leaning towards as far as a tactical decision, and then vice versa? Is there anything you're leaning away from, maybe from the sensitivity of what may or may not be happening in the economy, or do you keep a plumb line and just...
Great question. We don't keep a plumb line. We don't want to be held to a benchmark and therefore make what we think are suboptimal investments just because it's a certain part of the benchmark, right? We want to be bottom-up fundamental investors, and you know, we've been a bit cautious on the real estate market lately, and that's served us well so far. I mean, on the public side, I believe the S&P is up about 4% over the past year. The public REITs are down 20% or 16%. I'm sorry. And within that, office REITs are down almost 40%.
Yeah.
So we think there's a lot of opportunity coming. It's just, as you know, you have to be patient and you have to wait for these things to sort themselves out. And as they do, I think we're going to see a lot of great opportunities. Sometimes it feels a little bit early on some of the stuff we're looking at.
Yeah.
And that's on the public side. On the private side, we've had some real success. We made an investment in a private fund that does manufactured housing.
Yeah.
And that has been tremendously successful for us. So that's an example of, that's a sector we really like, and we invested with a group that was able to really generate some excellent returns for us. So I guess I'd say it's a bit of a mixed bag on real estate. It's really a time to, if you're investing yourself, to really know what you're doing on the public side, and if you're doing it private and you're trusting somebody else, make sure you're finding someone that's got a lot of expertise at generating, creating value through investment over, a long time period.
Yeah, yeah. So let's poke around a little bit on the office tenancy and this early spring there was a lot of drama in the small and mid-cap regional banks by way of the potential for asset or balance sheet write-downs. So a moment ago I mentioned CFA. So let's just kind of crystallize for everybody. The CFA designation is...
I'm sorry, it's Chartered Financial Analyst. It's a program, it's a bit similar to the CPA for accountants, I would say. It's a series of 3 exams. They're pretty rigorous, and you need to pass all 3. And you also have to have a certain amount of work experience that qualifies you for it as well. So it really just kind of gives you a good, robust background in financial analysis.
And so CFAs are, in essence, the analysts that the mutual fund managers listen to as far as if they're building a position or trying to liquidate a position or nurse a position out of a bad spot. So the investment bankers or the stock analysts are talking to the buy side as far as what to do with their positions. Okay, so it's from my perspective, you understated the importance of the CFA. That's like top shelf from my perspective as far as street cred. I'm just going to call it Okay, so with that as your background, and could you tell us just a little bit about your experience as a REIT analyst and what that looked like?
When I started following, I'm not sure what year, it was probably, late 90s, early 2000s, I really started following the industry. And, there were a lot of changes. I mean, the REIT industry, as you know, started probably 20 years before that, 30 years before that. It was very small. And it grew out of really financial distress, where there were a lot of real estate owners who had become over leveraged. They had too much debt, and this might rhyme with what we're going to go through here. And there was a banker at Merrill Lynch who figured out we can go public. We can raise money on the stock exchange, delever these companies, and that was really the beginning of what they call the modern REIT era. So from there, it has just continued to grow. It started off with just a few core groups, office and multifamily, and then it's just continued to grow. Now, we have storage REITs, we have single family housing REITs, we have data center REITs, and cold storage, and so it's been a really successful sector. I think it's generated very attractive risk-adjusted returns versus the other parts of public equity markets, and I think it's going to continue to grow as we go forward.
Cool. So now this is the juicy part of the steak right here. So most, and correct me if I'm wrong, but most office properties are going to have a commercial loan that has a maturity of 5 to 7 years. And the big hubbub over the last 18 months, as we've rolled into this, my perspective, not giving investment advice, but my perspective is transitory inflation, where we could be looking at deflation because the Treasury is not in the market buying, but the Treasury is rolling off assets at $90 billion a month. And so 18 months from now, we could be in a completely different interest rate environment. With that being said, offices that have taken out loans, property owners that own office buildings that have taken out loans in the last 5 to 7 years, all of those loans need to be refinanced or paid off in the upcoming 5 to 7 years just because of the shelf life of the loan. So here comes the hot plate to you. What's going to happen in that asset class?
Yeah, that's a great question. And I think one really interesting thing about real estate is that you've got the private real estate and you've got public real estate. So like I referenced the public office REITs being down 40%, right? Yep. That is the current view of the market. And we know that private office assets have not been marked down 40%. I remember I heard recently that an opinion came out that, or the average appraisal was down 25% on office buildings. That's what's rolling off. So what I think is going to happen is that it's the people usually that have to sell that kind of make the market in real estate. People that are, don't have much leverage, or they have plenty of money in the bank, or they have a performing property, they don't have to sell. So what we'll see happening in the office is we're going to start to see the forced sales. We're already seeing that. If they're down 25%, or there's going to be a lot you cannot refinance, right? Yep. And the reason they're down 25%, by the way, is because the cash flow is going to be down that much. So they're just not going to be able to support even their existing levels of debt, which, to your point, they're 3.5% loans that are going to become 6.5% loans. Yep. So there's gonna be a lot of pain. There's gonna be people who say, "Oh, well, we'll turn them all into apartments." We know that can't really happen. It's more complicated than that. These buildings aren't designed to be apartments, and many times it'd be more expensive to redo them and remodel them to do that versus just tearing it down and building an apartment building. Yep. So there's going to be a lot of distress in the office market, and I think it'll be interesting to see what happens in apartments. Apartments have had a very good run, some of the best fundamentals. If you talk to people that are apartment owners and you look at the rent trends, the fundamentals have never been better. And as far as rent growth, and occupancy. But we're now having more apartments delivered than ever. I think we're going to equal a record from the early 70s. So we have a tremendous amount of supply coming on. So that's going to be a bit of a question mark for apartments. Industrial has been the darling. It's by far, I think, outperformed everything else. And we know why, because part of that, if you remember back to Amazon buying leasing everything they could to keep, as they doubled their, I think they doubled their, their capabilities and delivery and now they're walking that back. And so we'll see that industry, we'll see if it continues to do well. It's been priced for perfection. So if there's any real hiccup in occupancy or rental growth, then I think we could see some issues there. Nothing like office, but that'll be an issue there. I think data centers, they've been called into question recently, but I think this new AI, whatever you want to call it, love fest or whatever, there is some true, there's some true fundamental drivers behind the AI story, and that's going to help data centers. So I feel good there. I think storage is something that people always worry about, but is consistently, as far as getting overbuilt or what the demand will be there. But I think storage is in a good place, and I think we're going to continue to see a lot of life events driving the demand for that in smaller footprints people are living on as they move back to the city. So I think storage is in a good shape. So a very mixed picture depending on your asset class, but those are kind of my high-level thoughts.
So how bad can office get? Will it get bad? How long will that be? And how do you identify when most of the pain is over and it's time to get active there?
That's a great question. And I think something that a lot of people might not realize too is we talk about office, and it's probably like anything, it's such a different story depending on what type of buildings you're talking about. And even before this, there was always going to be some buildings that were really non-competitive, and they're too old, they're Class B. It's just they don't have the amenities. People that are renting off, they want certain amenities. They want a certain lifestyle for their employees, and so there were already a lot of buildings running into that. Now with this, it's getting that's going to be heightened tremendously. So there's going to be demand for office, but it's going to need to have a lot of great amenities, and just a lot of office product doesn't have that, and is going to be non-economic. So there's going to be a real problem with that, and when is the time to get into it? That's I guess what I'm saying is there'll never be a time to get into the obsolete until it's not being priced as an office. until you're saying, well, I'm going to buy that thing and I'm going to put a storage center on it. Then it'll be time to get in. The other stuff that is is still attractive, or is going to be attractive, that has the amenities, the floor plans, the location that people want, we're going to see some opportunities, and it may not be too far in the future when people are looking to sell out of some of that stuff, and opportunistic people start to take a look.
So of the asset classes that you've touched on, if you had to identify the asset class that has the highest return potential, what would that be? And what would the asset class be that has the least standard deviation of returns, or the least amount of volatility?
I was going to say, because those are going to go together, because I think one thing we always look at is risk-adjusted returns, right? So that's, you served that up for me nicely. So I think, manufactured housing, I left that out. So again, that has a great return profile. I think storage does as well going forward. And, what could have potentially, the highest return with a lot of risk could be certain office assets, for example. Because it's going to get painted with a brush, and that's where there'll be opportunities. There's going to be some big, what should I say? It's risk-averse owners, maybe some, insurance companies or something, just say, I want to reduce my office from 8% to 4%, and stuff's going to start getting sold, and there'll be some gems in there. So I think it'll be high risk, but I would think that some of those you could see some high returns out of that.
So I think something just happened there that for the typical retail investor, the way your mind thinks. So you said taking it from 8% to 4%. That's an allocation for that asset class sleeve, correct?
Right.
Yeah. Okay. So then marrying that with a frequently mentioned approach that I hear from investors that they're laddering maturity schedules. Would it benefit investors? Take a $4 or $5 million investor. If you were to just wet your finger, put it in the air, what would an allocation look like from Hohheimer Wealth Management for private investments and real estate as a percentage of stocks, bonds, and?
Let's just say private investments. I would say private investments could be anywhere from 5 to 20% of somebody's portfolio.
Okay. And then how many different investments ideally would you have in that 5 to 20?
I would say 5 to 10 probably.
Okay. And so I'm here, that in my mind, that's 2 or 3% of the investor's net worth in any one position.
Yeah.
Yeah. Okay.
That's reasonable.
Okay. We're hearing it from the pro. Okay. Okay. I don't think I left any questions out. It's interesting doing this. I've got all kinds of questions in the back of my head, but so anyway, let's jump to the concept of liquidity. Have perspective, lessons learned.
Yeah, I think that liquidity is paramount in this in all investing. Real estate it's incredibly important. I knew, without listing any names, I was able to meet a very wealthy private owner of real estate, mainly office, and they had no debt on their portfolio at all. So they would literally, when they felt they weren't getting the rent they should get, they would leave space dark. I remember that. And they've, of course, sailed through all of these crises on their own. I've seen other things go down. I was following General Growth Properties, if you remember that, and that was it was a great mall company. They had built it up over decades, and it was a very high quality asset class. And their financial team just felt that they could run with a little higher debt, and a lot of times the debt was floating, or it didn't have a very long maturity ladder, and they just got caught in it and went bankrupt.
They lost it. Yeah.
So those are probably the two extremes, I would say. Everybody's somewhere in between there. But yeah, the liquidity is going to tell the story, and it's why you look at, we haven't talked about malls. Malls have an interesting history. Interesting for maybe a couple of years ago, people thought they were all going to be kind of dinosaurs, and I think that softened a bit. And we've seen, David Simon's always done a great job, and again, because he's mindful of his liquidity. He was, in fact, I remember, I think it was 2009. They were the first one to do a debt deal coming in, and they opened the market for REIT bonds at the time, and he paid, I forget what it was. It was a very high interest rate relative to where they normally do it, but you know what? He got the market going again, and then he was able to issue debt at much lower levels after that. So, yeah, there's a lot of lessons about liquidity, and we're, I think, going to be learning a lot more about that in the next couple of years, probably.
Yeah. By the way, as entities claim REIT status and have to distribute the preponderance of their earnings, is it 85% that they have to pass through? And then what is I'm foggy on that 85%. I think it's 85, but what is the tax treatment to the investors for a true REIT investment?
Yeah, I believe it's higher. I believe it's 90%.
Okay.
90 or 95. I have to look that up. So the majority has to go out. It is ordinary income. It is not a qualified dividend. Okay. So they did not receive that treatment of a qualified dividend.
Is there bonus depreciation on the REIT when the REIT makes the investment? Can that REIT pass through to the equity owners any bonus depreciation? Or?
They don't. What typically happens is that you often see a return of capital type situation because of the depreciation they have, but they're not
Okay.
I think what you're asking, bonus depreciation. It's not like a private investment where there's additional depreciation push forward.
Yeah, well, Spartan always does a cost segregation study, and typically it's 30% on the dollar that is distributed to investors, provided that there's 40% leverage. I'm sorry, 40% equity and 60% leverage. The less leverage, the lower the bonus depreciation. So, at any rate, the REIT market is always of interest. Okay, let's take a jump forward to the different sectors and their respective performance. And if I could even pivot that to, what do you, as you look forward, what do you see the next couple of years?
Sure. I've touched on a little bit some of the things I haven't talked about. Surprisingly, hotels have done very well.
Yeah.
Right. And I think people were surprised about that. During COVID, there was people weren't going to travel anymore. These hotels were empty. They really struggled finding people to work there, and the hotels have done very well. So a little bit of a surprise. In fact, depending on the time period, they may be the best performing sector over the last year. That seems poised to continue. Hotels are always a riskiest sector from as far as the lack of visibility they have of their revenues. But right now we see no signs of that slowing down. So I would not be surprised to see, there's a real desire for people to go back and travel again, to go places. So we all know there's no deals on hotels right now.
No.
Doesn't seem like that's going to change. So the hotel industry is doing very well. I think that a multifamily, like I said, that's going to be interesting to see how that plays. I think we're going to need strong job growth. The economy's got to continue to do well for that. And also the multifamily a lot of times is skewed towards usually more Class A, nicer, and that's tied to more job growth. Those are more expensive apartments. We're not talking Class C apartments, place over your head, which will be in some ways more defensive because people aren't trading down from there. I think manufactured housing will continue to do well. It's one of the lowest cost, especially more of the workforce housing place. I think affordable housing is going to be an interesting place to be. That's something, because I think there's a big demand for affordable housing, and our government, as you know, is very much behind that. They're changing zoning laws. They're doing everything they can to encourage middle housing or whatever you want to call it, but it's the affordable flavor of housing. So I think that's going to do quite well. I think that retail has been somewhat bifurcated. People, the grocery anchored smaller centers have been doing well. I think those continue to do well. That's just something we kind of now investors realize is more defensive than they thought it was. There was a time when those were really out of favor. Remember 2 or 3 years ago, everyone's going to get everything over the internet, and that's like, no, they're really not going to. They're going to go to their local place. I think there's, and now there's still more concern over the bigger malls, the Class A malls. How will they do? And then industrial. I don't know if industrial do as well. I think maybe just out of valuation. It's had such a strong run. Such a strong run.
So of those, from after accumulating some scar tissue as an investor over the years, quick interesting story, late 1990s, .com everything is going, and an investor wanted to buy 2,000 shares of Cisco Systems when it was like 135. And he asked me a question that will stick with me for the rest of my life. He said, "Ted, how bad could I get hurt?" And I'm thinking, I was at Merrill at the time, and I'm thinking this is going to be a big trade, and Mr. Investor, you should do this, and it's a great stock, and John Chambers, and the whole Merry Man. And he asked me how bad he's going to get hurt. So when I hear you talking, I'm thinking, okay, which of these asset classes are the most highest levered? Because I think I've got this right. Dodd-Frank, 2012. For storage, we lever at maybe 60%, maybe 65%. And once in a blue moon, you might find a loan for 10 years, but more oftentimes than not, it's going to be 5 or 7. So if you're levered at 60% and you've got a 5 or 7 year shelf life on that loan, I would say that's, in the world of risk, that's relatively low risk. So of those assets, which are the highest risk, all things considered? Would it be hotels that are the most? I mean, yeah, they've performed fantastic, but would they be the most levered?
They would be the most. I mean, they have the most operational leverage. Absolutely, from the point of view, their demand can go away very quickly. Yep. Everyone. Nobody knows. Everyone's can have their opinions. No one can predict the economy. But if we go into a recession, it's the first thing we're going to do is not go on vacation, not pay an expensive, and then all of a sudden their vacancy's going down. Their room rates going down, and it can get bad pretty quickly. So they definitely have the most apartments. Also those leases aren't as long. It's sometimes it's those the ones that have it used to be office, but it's typically those longer leases that'll protect you. That's one reason too. Like office, like say it's going to get bad. It's like, why is it not getting worse? Well, because there's leases involved, right? And somebody signed a 5-year lease and they've got a year or two left and they're just waiting, right? And they're not gonna renew. So you have to look at lease terms as well when you're evaluating the risk.
And some of those office properties in the Wall Street Journal, I've read that the owners are just walking away. They're not even trying to refinance. They're just handing the proverbial keys to the bank, and the bank owns the property now.
That's right. Well, and one of the things we saw in the last cycle, we called it extend and pretend, where the banks and the whoever had made the loan, the bank or whoever, did not want to get the property back. So what they simply did, and this was during the financial crisis coming out of it, they just would allow them to to put on a new loan and to make it so that they didn't have to give up the property. That is not happening as much now. I think the lenders are like, look, if you walk away, we're not going to help you. We're just going to take this asset and dispose of it. Because typically the person owning the building is not willing to come up with additional capital to put into it.
Let's jump ahead to by way of the refinance marketplace and all that the small and mid cap banks are dealing with. And by the way, just for the viewers of the tape here. Spartan, assets around the country, and our preferred lender type is a bank in the marketplace. Pea Ridge, Arkansas, just outside of Bentonville, where Walmart's corporate headquarters are. So we have an asset there, and finding a bank in that marketplace that understands the asset. That's our preferred venue for financing. What's happening currently, and if you let's talk just a little bit about the yield curve, and I'm really putting you to tightening the screws on you here, but the yield curve. Maybe you could explain to the audience what the inverted yield curve looks like currently, and how all of that mashes together into the market of refinancing an asset, and where will we be over the next couple of years? Now I just threw a bunch of mud at you.
Yeah,
so sorry.
Good. Okay, let me think about that, Ted. So first of all, we have an inverted yield curve right now, which is an unusual situation, meaning that the slope of the yield curve, if interest rates are here and the time to maturity is here, it looks like this. So that if you buy a 1-year bond, you're getting a higher yield than if you buy a 10-year bond. That is rare. It's often a sign of recession, that we're going to go into a recession. That's one of the signs people look for. It shows that there's it shows a view that the economic activity is going to be low, and therefore there's less of a need to have a high interest rate going forward, because there'll be a less inflationary environment. It relates to we're in the midst of a banking crisis. A lot of people don't say that, or we feel maybe it's over because a few banks were taken over. It's not over, probably just beginning in my view. And you referenced using a local bank. The real this time the eye of the storm in 2008, it was the big banks, right?
Oh, this
now
is
it's the regionals.
Oh,
now it's
fun.
The regionals, and I think there was a real debate of where we were going, and we really, I think, the big banks had much higher capital requirements and a much tighter regulation than the regionals, and it was going to go one of two ways. I think a lot of people thought the big banks were going to get less regulation, lower capital requirements, and come down to and be regulated like the regionals. And instead, what it looks like is that the regionals are going to have to come up to the big banks, and the big banks might have to go up higher in their capital requirements. So it's a real liquidity drain. It's a real negative for our economy, especially for real estate. The regional banks, one of the areas where they're really strong is in real estate loans.
Mm-hmm.
And, the big banks don't care to play in that a lot of times, mm-hmm. right? It's not something they want to get involved in. And so it's always been an area where local banks feel, regional banks, that, hey, we can make a good business out of this. And it's been a very interesting thing to watch unfold. It's not done at all in my view, and it's something that could really hurt, not only real estate, but just the economy in general.
So that's an interesting. Let's poke around just for a moment on that. So, if an investor listening has the bulk of their assets in a regional bank checking savings account and CDs, are they at risk?
Yeah, well, they could be. There's a $250,000 is what you're insured for on a typical account by the FDIC. And so when you think about your savings, that doesn't mean that you can't have more than $250,000, but that refers to kind of your cash balance, if you will. And so you just want to be careful that you can keep up to $250,000 in that uninsured, and you will be the government will back that. But the other thing, you can buy a mutual fund, mm-hmm. Which is just security that's in a different that will be protected. You could buy treasury bills, or you could have a financial advisor buy you treasury bills. All of those will be safe. They will be outside of that bucket. That if a bank fails, whatever they have in their cash accounts is what's really at risk over $250,000.
So you just mentioned something, that the cash accounts, and it seemed I've picked up on articles the last month or so talking about how M2, which is, and I think I'm going to get this right, that's checking, savings, CDs, and liquid retail and institutional money market funds. I think that's the bulk of what comprises M2. So M2 is now shrinking for the first time in the history of the country. And I'm really getting you with a zinger on this one, but that's a part of, we had quantitative easing going all the way back to 2008, basically till about a year ago, where the Treasury and the Federal Reserve are in there trying to prop up the economy. Now we're trying to take liquidity out, and so Treasury is letting bonds roll off, meaning that they used to buy from a bank a loan that maybe Spartan put on a property, and so they would buy that loan from the bank, so the bank's got cash, and the bank can go out and refinance another asset for Spartan. But now their Treasury's not in there. They're $90 billion coming off, or $90 billion coming out of the money supply. So where will that take us, and how bad could that get?
Yeah, it's we're coming off we've always heard unprecedented, but what happened during COVID with how they reacted, the monetary authorities, and growing the money supply as aggressively as they did, and adding liquidity to the money, growing the money supply. They've there's been a complete reversal where we're not only raising interest rates from near zero to over 5% on the Fed funds rate, but we're also shrinking the balance sheet. And how's that going to work out? We don't know, but it's usually not a good thing. And it's very rare for our money supply to be shrinking. It kind of, it probably needs to, just because of how much it grew. Yeah. It really went like this. Now it's coming down. So it's another macro risk to markets and the economy.
Yeah. Okay, let's jump to where has your firm been investing with real estate assets over the last, let's say, year or 18 months?
So I think I mentioned that we've done two investments in manufactured housing. We like that area, and then we've done another private investment that's not in real estate. It's a loan. It's a loan fund, leverage loan fund. So that's not in the real estate area, but we're getting ready to do a fund that is going to invest in affordable housing, as I said, and build a master plan community in a way that will make it much more lower price than the other housing options in the area.
Do you want to talk about that at all? Or?
Sure. It's going to be, I can't get into specifics yet because we're still registering the fund and everything else. But basically what we're going to do is we're working with a couple partners. We're going to be we're putting up the money to develop the lots for sale, and then we're working with a major manufacturer of manufactured housing who is going to be bringing us the homes for wholesale price. They'll deliver it and affix it to the property, so it's not a movable home. It's going to be like a stick-built home. And then we're also going to be taking advantage of this new Fannie Mae manufactured housing, MH Plus they call it. And basically, there's always been a problem with non-stick-built homes that they often didn't get the same mortgage terms. So these mortgage terms will be just as good as if they were stick-built homes. And it's part of Fannie Mae, and who's part of the government's, as I said, push on affordable housing. So they kind of want to use these communities as examples of how we can go out and create more affordable housing with good financing terms for mortgages.
So what you just said maybe 30 seconds ago, that the banks have an opportunity to play with this asset class, whereas maybe formerly they didn't. That seems huge to me. Am I picking up what you're putting
it's
down?
a big opportunity.
Yeah.
Absolutely.
Yeah.
Absolutely. Because as we know, we've all seen, we're short housing.
Yeah.
And that's part of the reason what's keeping it high, and it's impeding our economic growth. So I think any sort of solutions like this where we can go in and build really attractive subdivisions and master plan communities that are significantly cheaper than the surrounding areas, then all of a sudden the people that work in the community don't have to drive an hour to get home.
Yeah, that's got sizzle to it. Okay, the risks to real estate investing, and maybe answer this one from the perspective of the investor who is engaging with Spartan. If you could look over their shoulder and maybe kind of steer their thinking, position sizing, maturity schedule, combination of asset classes, what would 5 or 6 sentences of coaching look like from the pro?
I would take a look at how it's being financed. You referenced that, how much equity is going in, how much debt. I would look at where the assets are located. If you have any questions about that, and obviously you guys aren't doing anything you don't really believe in, so I'd just say, hey, why are you going into this city or that city, or why do you like this thing? And just try to understand the rationale behind it, and what the general terms are as far as you say, liquidity. And it sounds like maybe it's a 5-year hold. And you'll say it's 5 to 7 depending. Because you also want to give the manager flexibility. I think a lot of times if you don't invest for a living, you think, oh, this is like going to the grocery store. I mean, you never want to put a gun to somebody's head who's managing money and say, oh, sell it in 5 years. I want to say, sell it when you can get me my best return.
Yes.
And maybe in 5 years, there's a regional bank crisis, and then, keep it for a while.
Yeah.
You keep it for 6 years. Just, I'd rather have a 20% return than a 15% return because you use your judgment on when best to sell. Yeah. So I would say try to understand these factors, but also just make sure that you trust the person who's doing the investment, and that they've got the skills to execute on it, and then let them do their job.
Yeah. So last question: how do institutional investors evaluate real estate? And there's probably a comparing and contrasting of what do you already have enough of, so you're looking for that puzzle piece that you don't have.
Yeah.
But from a 10,000 foot level, we'll finish.
Yeah, I think really look at kind of the return. What's the on the public side, we're really comparing things to the public equity markets. So when we talk about the REITs, like I mentioned it, the S&P 500 versus the public REITs. So I think there's a real comparison there between the equities, public equities and public REITs. And on the private side, people are, you're going to be looking at, what's your return, what's the IRR of the investment. And I think one thing that's different for institutional versus individuals is I think individuals have usually they're more attracted by current cash flow. So an institutional investor, maybe you get a 12% return, but you don't get a dime until, year 6, and then you get it all, you're fine with that. Where I think a individual would like to see, some quarterly distributions if possible, and they're going to value that a little bit more because it's part of their P&L. So I think that's a major difference between institutional and individuals.
So give us if somebody would like to reach out to Hohheimer Wealth Management, who do track you down on the internet? Who do they talk to in the office? Who's the intake guy or gal that
you can really contact any of us. We're on the website, we're right there. But and we've got a full suite of individuals that are wealth managers and asset managers and so and it can also depend on, like I say, maybe you've really got a philanthropic need that you want to address, and so you're going to reach out to Mark Dieter, who heads that up for us or something. Or you have an investment question, maybe you're gonna contact me and say, hey, I'd like to talk about investments. Or you're going to have something on the wealth management side, you're contact David Hohheimer. But we're there. We're always happy to talk to people. Our contact information's there. So yeah, send us an email, give us a call. We're in the office every day.
Easy peasy. Well, gang, anybody here have a question that you want to throw over the fence at us? Hamid, yeah, we'll just start and then go to yep.
So you mentioned that the REITs were down by 40% and private investments were down by 25%. So there's a gap there. Do you know what the driver is behind that?
And maybe let's just repeat the question for the brief.
Certainly, absolutely. So the question is, I mentioned that public REITs, office REITs are down 40%, and then I mentioned that appraisals on office buildings are down 25%. What's the difference? So the very different. So the REITs, it's easy to measure because they're stocks, and so that is truly down 40%. That's the price decline of them, down 40%. The other is based on an average of appraisals. So an appraisal is not a transaction. So one thing that you typically see is that the public REITs lead the private valuations. So there's always a little bit of a upward bias on appraising real estate, right? Because people own it and they want to, and they're your client, they want to hear good news. So I think it's different. Like, we're not seeing that in the transactions. So maybe they're down 25%, but they might be down more if you actually want to sell. Somebody can say your $100 million office building is worth $75 million. It's like, okay, that's the appraisal. Say, but I want to sell it for 75. Okay, well, that's a different story. Now we're going to start putting out books and everything else, and maybe 60 million is the winning bid at that point, and now you're down 40%. I'll tell you that the right now, public REITs are trading about a 10% discount to their net asset value, which is very wide historically. That's unusual. They usually trade pretty close to net asset value. So that means that either the REIT stocks are really cheap right now, or that the NAVs are going to probably come down another 10%, and then we'll be right in line where we usually are.
And so the market is betting that the net asset value is the number that's wrong. And the stock price.
That's what that would imply. Yeah.
Good on that one, Hamid? Yeah.
Yeah, I do actually.
Okay.
What is the most challenging part of a CIO's job?
Let's repeat that question.
Yeah, what's the most challenging part of a CIO job? Just the markets are changing constantly, and just the amount of information out there. Things seem to change more quickly now with technology, with the amount of information and how quickly it gets circulated around. So yeah, it's just there's a lot going on out there in the world, and so it's always challenging to keep up on that. And yeah, I'd say that's the most challenging part: information flow, the speed of information.
Yeah.
We have the skills.
Thank you.
Yeah.
Lily, did you have?
Yeah, I'm interested in understanding more about the affordable housing part. First off, does your firm, are you placing people's money as a portfolio and then you charge, placement fee as in or management fee based on like a portfolio of stuff, or can an investor just invest in just this one fund that you have that is going toward the affordable housing?
I think the question is, can you just invest in one fund without being a client for other services? Is that
Exactly.
kind of what you're at? Yes, that is definitely possible. This is you don't have to be a client to invest
I
in it.
never heard of, I wasn't familiar with this asset class. So where is it in Washington State, this development that you're making? And are you one of the first people who are doing it? Or is it like really prevalent all over the US?
Good question. You're asking about and again, we're registering it now, and so I really can't talk much about it or to be seen to be promoting it in any way, which I'm not. I don't know of a lot of other people doing this. We hope to think it's kind of innovative, and that.
Where is it? Is it here? Or you can't say.
It's not in Washington State, no, but it's on the Western U.S. and it's something that we hope we hope it's going to be successful, and we'll continue to roll out more funds like it, and they'll be throughout the country. They won't just be in one location.
It would push the valuation of existing houses down then if you in those communities that have those kind of cheaper alternatives.
Well, who knows? I mean, the whole push towards affordable housing, you could argue, could do that, which I think is kind of what people are trying to achieve. The government wants more affordable housing, means more muted home price appreciation. I don't think like what we're doing one community. It's not going to it's not a tremendous, you're right. If there's a huge amount of this going on, that would definitely have an impact. Part of what's kept housing prices high is the shortage of housing. So if we eliminate the shortage of housing, that will definitely have a dampening on existing home prices.
Wade, did you have a?
Yeah, there's a couple sectors REITs I'm particularly interested in investing, but I just don't want to jump at a long time. So one sector is the data center you mentioned, like if you take like Digital Realty or American Tower, those seems like really good charts, but recently they're pretty depressed. And also the mortgage REITs, they seem to be depressed as well. So what were your thoughts on those two sectors?
I think as I mentioned, AI is going to increase data usage, demand for data. That's good for the data center REITs. The data center REITs, there's always been kind of a worry about supply. Like, can we just create more supply of data center REITs? And there's also been a worry of, some of the biggest, cloud providers and whatever, just doing everything themselves and not really partnering with that. I think that's less of a risk. I think the data center REITs have, I don't see any problems with the data center REITs. I think it's a good sector. It's a growth sector. So I think you could use volatility there as an opportunity. The mortgage REITs are a completely different thing. That's a history. That industry has a very checkered past, and it's checkered not by doing anything illegal, but just typically there's a belief they're hedged, and then it turns out maybe they're not as hedged as they thought they were. There's a lot of leverage in those models. They're typically they're owning bonds and they're leveraging the bonds. So that's a much higher risk sector. And you really, before I bought any of those, I'd really want to dig in and try to understand what they owned, their hedge book, and that they're gonna be okay in different interest rate environments.
Okay, so data, you had the favor of the
Definitely I'd take the data centers over the mortgage REITs for sure.
And with the inverted yield curve, if short-term rates are higher than long-term rates, typically when you get into a recession, and correct me if I'm wrong, but when you get into a recession, there's a reversal there, and I think it's Investopedia that describes the bull steepener as the bucks are flowing into the short end of the curve, pushing up the value of those bonds and pushing down interest rates. So you get the short end of the curve comes down, and then the longer end of the curve reflates because some of the capital is leaving that part of the yield curve. And so there's a general steepening to the yield curve where you get back to normal, where a 2-year CD may pay 3%, and a 10-year CD or a 15-year CD may pay the typical 1.5 percentage points higher than the short end of the curve. So there's got to be some reflexivity to what's happening in the yield curve with those mortgage REITs, because they're going to be really sensitive to volume coming through, and all the rest of it would be my sense.
Yeah, those are yielding like 15, 17%, something like that.
So the comment was they're yielding 15 to 17%. So Alex, what does that tell you?
Yeah, so that the market's concerned about that yield, right? And they don't believe it's sustainable, right? Is what they're signaling. And there's certainly been some companies. Analyst's been around a long time. There's some companies that have been doing it for a while, but it's definitely something where if you go back and look at dividend histories, you'll see there's a lot of volatility. And you'll see companies that were paying a high dividend and then we're paying no dividend. And also, as I said, there's a lot of leverage on the balance sheet, so sometimes book values can get compressed really quickly.
Alex, do you think there's a 60% chance or a 30% chance that the stock market might make a new low for this over the last 18 months? I mean, we've seen a new high about a year ago.
Over the next 18 months, do I think 60% or 30% chance we kind of revisit or go down 10 or 20%?
Yeah.
I'll take 60%.
Okay. So okay. Yeah.
So you think 60% that will go back to the October low?
Not October low. He just said, a correction or 10 or a 20% type correction. We're seeing earnings degradation. We've had a very strong run, and we've seen a lot of there's frothy activity, investor activity.
The breadth is terrible.
Breadth is terrible, and there's an AI bubble going on. I mean, it just feels like we're gonna have a breather.
We saw this in 1999. The Nasdaq was up 76%, and I think like 85% of that was 7 stocks. The same thing is happening today. So what?
Yeah.
Anybody else? Hamid.
Yeah. You talked about like Fed policies and how it's driving the economy. What about what's happening with the BRICS? Like the BRICS countries decided to buy and sell oil, and for example, the yuan. Like the fact that the U.S. dollar is losing its position as the currency of the world. Like, do you think that it has any implications for the markets going forward?
I do, yeah. First of all, I mean, I'm not sure that it's not clear that the U.S. is losing its position in the reserve currency as the reserve currency, and the BRIC, the emerging market story has not really worked as an investment. It's underperformed over the last 10 years. And some of the reasons, and we look globally. So we make investments in the emerging markets. We make investments in Europe and EMEA. So we have those in our portfolio. So there's definitely opportunities there. But just like as a broad brush, some of these markets I think have suffered from poor governance, Communist Party rule in China, right? I mean, China's been an amazing economy and some of their companies, but I mean, they disappeared, one of the most important executives in the world, certainly in their country, So they face those issues. Brazil faces, corruption and whatever. But so I'm not to say there's not good investments there. I just think you need to be bottom up, meaning look for specific investments there, specific companies you like. I wouldn't just buy the country and say, Brazil's going to grow because they're poor, or poorer than the U.S., or China's going to. It's like, no, or India. People talk about India. I mean, there's real issues they have that have, I think, what's made the returns suffer is just poor, weaker rule of law, weaker property rights, political issues, like I said with China. So there's opportunities in the BRICS, but I just wouldn't buy them as a blanket asset class.
Thank you.
You mentioned you have investment in Europe. I'm particularly interested in that because I'm going back to Europe. Which particular part of Europe are you investing in, and what's your outlook?
Let's repeat that.
Sure. Which particular parts of Europe are we investing in, and what's our outlook? So, Europe has, our investment process is we are bottom-up fundamental investors. So we're just looking for securities that we think are more attractive than other securities. So, without getting into specifics, we own a company that's based in France. We own one that's based in the Netherlands. We own a German company, and they all kind of have unique investment attributes. So we're not really looking top down and saying we think Germany looks great or we think France looks great. We're just looking for individual securities that we think are have the potential to deliver really excess yields or excess returns.
Is it REITs or is it others?
We don't own any REITs, and no, they're operating companies, industrial companies, or various, not. We don't own real estate companies in Europe.
I think we're there. Okay, so those of you online will say goodbye, and thank you for joining us. And by the way, one last comment. Next month is the second of two talks by attorney Shreya Lay of Lay Law with regard to asset protection. So those that are looking to protect that $2, $5, $20 million net worth, and we had the initial interview with Shreya a couple months ago, and she's going to come back in July for round number 2. So we will see you all then, and thank you for joining us online.